Hello everyone, welcome to my channel Study Management. In this video, we will try to understand the concept of capital structure. Financing decisions are one of the important decisions that the finance manager of a business has to take. Financing decisions are mainly concerned with the amount of finance that is required to be raised from various long-term sources of funds. Generally, the finance manager of a company comes across three common questions. The first one, how much finance is required to achieve a financial goal? Let us assume that a company wants to make an investment in fixed assets. Say it wants to purchase a new machinery costing rupees 10 lakhs. The next question that comes in the mind of a finance manager is from which sources can the funds be procured? The major long-term sources through which the finance manager can raise are through debt, that is through the issue of debentures or bonds, through the issue of equity shares, or through the issue of preference shares. The company will have to pay interest in return if the company raises the funds through issue of debentures. Similarly, if the company raises funds through the issue of equity shares, it will have to pay dividend in return, and also even in the case of preference shares it will have to pay a fixed dividend to the preference shareholders. The next question that comes to the mind of the finance manager is in what proportion will the finance be raised? That is, in what percentage or ratio can he raise the funds that are required from the available long-term sources? The finance manager will definitely opt that combination of long-term sources that will fetch him the optimum benefit. Capital structure is a combination of capital from different long-term sources of funds. As you can see here in this picture, the pie chart represents the capital structure of a particular company. It shows that 60% of the capital is raised through the issue of equity shares, 15% of the capital of the company is raised through the issue of debentures, and remaining 25% of the funds are raised through the issue of preference shares. It is important to note here that a finance manager cannot randomly select the sources from which he can raise the funds. He cannot take a random decision of raising a fund from a particular source without any proper analysis or base. He cannot just take a vague decision saying, I will raise 70% of the fund through the issue of debentures and the remaining 30% can be raised through the issue of equity. It is very important for a finance manager to see to it that the proportion or the ratio in which the funds are raised yield maximum benefit both to the company as well as the shareholders. Let us understand this with the help of an example. Let us assume that a company is in need of capital of rupees 5 crores. The finance manager of a company has to raise the capital from the available major sources of funds. That is, as mentioned earlier, he will have to raise the capital either through the issue of debt, equity, or preference shares. He will have to create a mix of different options to develop a suitable capital structure. He has various options available to him from which he can raise the funds that is required by the company. He can either raise the funds through the issue of equity shares or through the issue of both equity and preference shares or through the issue of equity and debentures only, or he can raise the funds only through the issue of debentures, or also he has the option of raising the funds through the combination of equity shares, preference shares and debentures. The finance manager has to select the optimum capital structure for his business that will benefit him the most by maximizing the value of the shares as well as the value of the firm and thereby reducing the cost of capital. Now, let us understand what is meant by optimum capital structure. It is very important for a finance manager to see to it that the mix of capital that is raised through various sources of funds ensures optimum capital structure. Optimum capital structure is one which maximizes the value of the firm and minimizes the overall cost of capital. It is that combination of capital structure that aims at maximizing the wealth of the shareholders and also maximizes the earnings per share, and on the other hand reduces the overall cost of capital. Let us now understand the meaning of cost of capital. The term cost refers to the amount paid to gain something in return. It is a sacrifice made to gain something in exchange. For example, if you want to purchase a pen costing rupees 10, you need to sacrifice rupees 10 in exchange of that pen. The term capital refers to the fund that is required by the business. Therefore, cost of capital is the price that you pay for the capital that you are using for your business. Let us understand this with the help of an example. Suppose I want to purchase a laptop costing rupees 50,000. I have various options through which I can arrange the money required to purchase the laptop. The first option is bank. I approach the bank to offer me loan of rupees 50,000 to buy the laptop. The bank agrees to lend me the loan of rupees 50,000 at 10% interest per annum, which means I will have to pay rupees 5,000 as cost for the amount of rupees 50,000 lent by the bank. The second option is friend. I approach my friend to offer me loan of rupees 50,000 to buy the laptop, and my friend agrees to lend me the loan of rupees 50,000 at 5% interest per annum, which means I will have to pay him rupees 2,500 as cost for the amount of rupees 50,000 lent by him. Now, I will definitely opt for the second option where the cost is less, that is rupees 2,500. Similarly, even in the case of business, a finance manager has to select that particular option or that combination of sources of funds that has lowest cost of capital and yields more returns than the cost paid for the capital. I hope you liked this video. Thanks for watching, and please do like, share and subscribe to my channel.